And it is time for the word on Wall Street. Top investors watching your money. Joining me right now, Michael Lee strategy founder Michael Lee and Bulltech Capital chief market strategist Catherine Rooney Vera. Great to see you guys this morning. Welcome, Catherine. Kicking things off with you, as Janet Yellen and former Treasury Secretary Larry Summers are both saying that more work is needed from the Federal Reserve to bring inflation down. Of course, the Fed's target is 2%, which is way down from where we are right now. Larry Summers also saying this weekend that we may very well enter a recession later on in the year. He's still worried about policy. Your reaction, and what does that mean to the macro story?
Yeah, Larry Summers has been talking about this for quite some time. I think often at odds with Janet Yellen. And I think he's right. He's looking at four primary indicators that are showing that we are on the precipice of recession. He even recently highlighted that it would look similar to Wile E. Coyote and falling off the cliff and not realizing he's off the cliff and then dropping like a rock. So that could still happen. We have inventory to sales ratios that are showing that inventories are accumulating, which of course means that demand is slowing. And I think that's right. The question I think that is still out there, and a lot of us economists are debating, is whether that needs to coincide with a jump in the unemployment rate. And I still think it does. You have demand forces and you have supply forces both working to push inflation higher. It's lower than it was at the peak. The peak was 9%. Now we're at 6%. But as you say, Maria, that's way off of the 2% target. There's fiscal factors in effect. The U.S. deficit is still 6% of GDP. We're talking about a debt ceiling limit of $30 trillion. The Fed is no longer effectively monetizing by buying those treasuries. So there's a lot of risks at play here. And I do think it's going to require, Maria, a contraction in demand, which is precipitated by loss of jobs. I mean, people who lose their jobs start to tighten their belt. And that's, I think, what's going to require inflation to come down. And who's at fault? There are a lot of factors here. There's monetary, there's fiscal, there's government factors, there's supply factors. But I think it's going to take a recession to get us back to that 2% target.
Yeah, and the exact quote from Larry Summers is, I think that we've got an extremely difficult economy to read. On the one hand, we've got a set of very, very strong statistics. I think the data coming in a way that confirms the view I've had for a long time, and that is inflation does not get back to 2% without a meaningful slowdown in economic activity. And Mike, that's what we're seeing already. Twitter is the latest to say it's laying off workers. They're laying off another workers in the latest round of cuts, this time focusing on the engineering teams. More than 22 million Americans are turning to part-time work now after the pandemic, burnout, working a maximum of 35 hours a week. Mike, you've got a real change in the backdrop in terms of work right now, and a whole host of job cuts as we watch an economy that is slowing.
Yeah, it'll be interesting to see how the next jobs number comes out. It's not this Friday, it's the following Friday. Of course, last month we got a pretty shockingly high jobs number. I believe that the assumptions that the BLS is using in a post-COVID world are not as accurate as they say were pre-COVID. I think, as you just mentioned, Maria, without a meaningful slowdown, inflation is here to stay. I believe the labor market is worse than is advertised, but is still too strong to get inflation down to 2%. There's only two ways to solve inflation: supply and demand. And the Fed is going to keep raising rates until that demand is totally and completely crushed. And the way that I like to think about it is the longer it takes to get to this inevitable recession, the worse it's going to be. And why is that? It's because the Fed is going to have to get more aggressive and more aggressive and more aggressive until it breaks the back of inflation. As I've mentioned before, inflation is not just a markets killer and an economic killer. It tears societies apart by their fabric and can turn your country into a banana republic. So I think Labor, that's probably going to be the last thing we're going to see. And historically, this labor market, the unemployment rate bottoms only a few months before the start of a recession. So we could continue to see headline numbers that are pretty strong for the next few months before what I think is the eventual dam breaking.
Real quick, what does this mean for investing, Michael?
Look, the more the market fights the Fed, right? Do not fight the Fed. The market is fighting the Fed. It's making their job harder, and it's going to allow them to be more aggressive. And it's making it incredibly difficult to invest. But during that situation, you can buy short-term treasuries for close to 5%, and then I own the defensive sectors, consumer staples, utilities, healthcare.
Catherine, you real quick, what does it mean for you? Do you want to buy stocks here or avoid?
No, I like the defensive sectors and I like short-term bonds. I think bonds are the way to go at this point. The Fed is going to hike more than I think the market expects. And one thing I'll point out, Maria, is that if, in fact, inflation remains higher for an extended period of time, even though the Fed is on pause, the Fed isn't going to cut rates. The Fed is going to resume an upward trend in rates, and the market is wholly not prepared for that.
All right, we will leave it there. Great conversation, guys. Thanks very much. Michael Lee, Catherine Rooney-Vera, we will see you soon.